Yep.
All right, we're live?
Mm-hmm.
Good. All right, it is Wednesday, July 29th. We are about to close out the month. So if you're watching this live or if you're listening to the podcast, welcome to Invest in Education Academy. Today, we're going to talk about something a lot of people think they know about, but they're not sure what it is, or they heard the term and they didn't want to raise their hand and say, what is that? Real estate and investment trust. It's a kind of one of those things that people know it's a great way to invest, but don't know how to do it. We're going to talk about that today. So if you're wondering what the subject matter is, that's it. If you want to share this with a friend right now, this would be a great time to do it. Or if you want to download the podcast, you can feel free to do so. Of course, I'm with the co-founder of Invest in Education Academy, Leon Noble. So Leon, you want to introduce them to the topic today while I do some housekeeping?
Yeah. So we're going to talk briefly about Reits. And the reason is, as Brent said, we get a lot of questions about Reits. It's kind of a, like Brent said, it stands for Real Estate Investment Trust. Long name, sounds complicated. Some people are kind of scared of it from my talks with people, discussions with people, but it's no different than investing in any other stock. REITs are, so basically what a REIT is just a company that by its definition owns real estate, right? So the business of the company is to actually own physical real estate. Now, there are different types of real estate. When I say real estate, most people think of homes, like personal homes, right? Well, REITs typically own various different types of real estate. So they can be, like I said, personal homes. They can be businesses. They can be office buildings. They can be what else? They can be retail. They can be hotels.
Yeah, like, I mean, really anything that involves land and a structure.
Right. Yep. So another big one is healthcare. So it's basically the business of REITs is to own, as Brent said, either land and or structure. Structure meaning typically buildings that then other companies rent out and rent and or lease from these companies. Now, the main reason people invest in REITs, it's not for the products. It's not for the service. It's primarily for the dividend. So REITs typically pay much higher dividend than most stocks. And definition of dividend is it's the amount of money that the company is going to pay you out quarterly from the company's profits. So an example is if a company pays a 4% dividend, that means they're going to take they pay 4% dividend. The money you invest in that company, you're going to get 4% back on your money, no matter what the stock does, right? So if you invest $10,000 in a company, if at a 4% dividend, you're going to make back in that year. You're going to make back via dividend payments $400. The stock may go up, the stock may go down. Regardless, you're going to make that $400 back. You can have it in your pocket. So they're really good to actually to increase your gains or to pad your losses.
Yeah,
because
so,
go ahead.
This is one of those things that a lot of people want to use real estate investment trust to kind of hedge against the market, because it's a different type of investment vehicle. So they're kind of opening up their exposure to a different investment type to put into their portfolio to give them an overall better asset allocation module, if you will.
And another thing about it is it's an inexpensive and easy way for the average Joe to invest in real estate. They're not talking about any 20% down. We're not talking about closing costs, none of that. You just buy the stock of the REITs, and now you're essentially in some form of fashion in the real estate game. It's a lot easier way to get into real estate. And again, they usually have those higher dividends that I'll go into in a minute. Brent, if you could throw up slide 1.
All right.
And so what this is going to show you, this is going to give you a basic overview, definition of what a REIT is. And then we're going to walk through some of the actual examples, which I given earlier. Then at the bottom of this one, we're going to have some actual REIT companies that we found.
And while I'm pulling this up, one thing to note, and this is for everybody watching, real estate investment trusts work slightly differently than the average investment. Like the way their dividends are paid out, a lot of times it has to do with appreciation of the land and or them turning over different properties, selling it, buying and selling properties. So when they're doing it inside the portfolio of the REIT, you're not getting hit with the taxes, short-term, long-term capital gains, like you normally would if you were directly buying the property. So you need to also think about that when you think about the leveraging value of a REIT.
Yep.
So can you see my screen now?
Nah, no, yeah, I still see you.
Okay.
Yeah.
And for everybody listening via our podcast, we're looking at a slide right now that goes through real estate investment trust, or REITs, R-E-I-T. Normally people say REITs just because that's just what they normally do. And so REITs are companies that own or finance income producing real estate across a range of property sectors. REITs provide investors with the chance to own valuable real estate and access high yield dividend based income. So that is the chart we're looking at. It just gives the definition. It gives some examples of sectors within REITs: office, retail, lodging, healthcare. And then we're going to go into the companies that we found as they relate to REITs that you can actually invest in.
Right. So as it's just showing, it's not just, as I said earlier, it's not just when people think real estate, they just think, home real estate, residential real estate. And right here we're showing that REITs actually more engaged in business real estate, like office buildings, retail establishments, things like Walmart, Macy's. A lot of those buildings are owned by REITs, not by the companies themselves. Lodging, hotels. Some of them are now getting into Airbnbs because a lot of hotels are actually done via franchise. Some of those franchisees actually go through REITs to buy the property. And then healthcare is a big, as we know, the population is aging. This whole COVID thing has kind of brought to light the nursing homes. A lot of those are owned by REITs as well. So these are some of the industries. There are a lot more. These are only 4 that we're showing here, but there are a lot more industries that REITs actually play in.
And for anybody watching, you're thinking, oh, well, you guys didn't think about agriculture. We have, and agriculture is part of it. A lot of REITs own agricultural land, but also right now what's happening with marijuana growers. There's a lot of land designated for marijuana growth farms that are held within REITs. And the beauty of that is many, like we talked about before, the marijuana industry still has its issues, but the companies that own the real estate have a tangible asset. They have are considered a real asset. So for that reason, when you look in that space, there are other ways to invest besides just directly going at growers. You may start thinking about the REITs that provide land to growers. So again, our goal is to give you all new ways to think about investing, but to also demystify the shock value of somebody walking in and saying, oh yeah, I just added real estate investment trust to my portfolio. It's giving a dividend of 5% annually. It doesn't mean anything. It just means they own a real estate investment trust, or similarly, it's kind of like an ETF. It's very similar. And they get a dividend of 5%. So
right.
That's it.
So, yeah. So, I mean, a REIT is a REIT. The underlying of a REIT, what they're investing in is typically hard assets, like Brent said, like land or buildings, and they pay a high dividend. That's really the crux of a REIT. But I'm going to go a little further into dividends and show how different they are. So typically, every time we say the market, we're typically talking about the S&P 500. So the average dividend right now that a S&P 500 company is paying is roughly 1.9%. So we'll say 2%. The average dividend for a REIT is 5%. So we're talking about more than double. Now there's another form of REIT that's called a mortgage REIT, and mortgage REITs actually own the mortgages that these companies then finance these buildings on or this land on. So you can actually own a REIT that owns primarily mortgages. Those typically pay 10.5% dividend yield. So again, a typical stock's going to pay you roughly 2%. A property REIT is going to pay you about 5%, and a mortgage REIT is going to pay you about 10.5%, 10.5%. So that shows you the power of REITs. Because remember, you're going to get that payment every year from that company, no matter what the stock does. If the stock rises, that REIT return at 5%, 10% will pad your gains. And if the stock drops, the REIT will then kind of cushion some of your losses. So those are some powerful numbers. I mean, again, 5% for a property REIT, 10% for a mortgage REIT. And remember, most savings accounts are paying you maybe 1.5%. You're lucky to get that. If not, a little less. So REITs pay a huge dividend relative to savings accounts and relative to just general stocks.
And if you have a question about REITs that you would like for us to answer during this quick live, please submit it so we can read it and try to get you an answer. If you are wondering, how to listen to this, and I got a personal message, can I listen to this later? Yes, it's going to be on our podcast, so you can definitely listen to this. But we're about to continue going through, and as we give you all this information, the goal is to help you leverage your money. to learn how to make your money work for you. The goal isn't just for, Leon and I to go live every Wednesday and kind of talk about investing and then we leave and continue life. Do something with the information. Change the way you look at your portfolio. Change the questions that you ask during these lives, because it really is a great opportunity to, get your questions answered, or, have a friend sit in or your kids sit in. We will continue this conversation at the Facebook group, and that is Investing Education Academy. Just search this on Facebook, you'll find us. So I just wanted to say that as we go into the next slide.
And just on last point on this point, on this slide, you see at the bottom we have 4. We're not going to cover those now. We're going to come back at the end and talk about those. But as you see, we found 191 different REITs that are publicly traded. So as Brent said, they're out there. Use this information and go out there and start researching REITs. There are a ton of them. There are 191 that we found, and I'm not even sure if those are all of them. There are 4 here that we're showing here. But go out there and research REITs. Just don't research the same old stocks, which are fine if they're working for you. But again, these are paying you 5 and 10% per year on your money, no matter what the stock does. So REITs are powerful tools.
And just so you understand the behavior of most real estate investment trusts, they're not fast movers on the appreciation side of the actual stock. Normally, not always, normally. So when you look at a REIT, you're normally looking at it because of the stability of it and because it's paying out a dividend. So if you see the market explode and, have a tear, up or down, the REITs tend to stay somewhere in the same range.
Right. And on that same note, with the COVID drop we had recently, the big plunge of the market, if you're sitting on a 10% paying REIT, and let's say between the beginning of the year and now, your portfolio is down, I don't know, 10, 20%, you've already been cushioned. By the end of the year, some of that loss is going to be cushioned by the REIT, the payment you're getting from that REIT, because you're going to get 10% on your money. So REITs are really, really powerful ways to cushion losses, and like I said, and accelerate gains. So 5% to 10% is what REITs typically pay.
And still understand that they are an investment. So their risk, we don't want to sound like we're saying these are guaranteed. You still have to research the companies. You still have to look at their financials. Look at their financials. One of the things that's in this marketplace is a lot of companies know that people turn to REITs for that dividend payout. So if a company is structured as a real estate investment trust, it is imperative for them to appear to have a very strong dividend. And this is where Leon and I differ from somebody who's just giving you hearsay information, or they really haven't been in the market. We've been in the market for a while, and we've seen companies that inflate their dividend because they want to still be in good standing and still stay an attractive company to their investors. So they are actually using leverage money or borrowing money from banks just to pay a higher dividend than their competitors. And because they're leveraging this debt, the company's slowly imploding. But because you receive the dividend on a timely basis, you're not looking at the details of that company because you think real estate investment trusts are safe. Or, REITs aren't as volatile as the traditional stock market investments. They are volatile, and sometimes there are people who aren't doing the right things when they run them. So do your research.
Definitely, yeah. A REIT is no different than any other company. They numbers can be manipulated too. As Brent said, some companies will inflate their yields just like a regular company can do. A REIT can as well. So yeah, definitely do research. But REITs are definitely one really good way to increase your returns in your portfolio. Yes, you go slide 2. Okay, so of course the question is now, how good are they as far as investments? Well, this is showing over, I believe it's 20 years. Yes, this is a 20-year percent return chart of REITs, generally REITs in the market versus the general market, right? This is counting as a Russell 3000, which is similar to the S&P 500. It's just tracking the general market.
And for anybody who's listening to the podcast right now, we are going through a simple chart that just lists the average annualized total returns of real estate investment trusts over a 20-year period, looking from 1998 to, where is this link? What is it?
This ends at December. This was back in 2015.
Okay, so 98 to 2015.
Right. Mm-hmm.
And we're looking at we're comparing the real estate investment trust to the Russell 3000 index.
Right. Which again, the Russell 3000 is just kind of similar to the S&P 500. It just tracks the general market. But what we're seeing here is now, so what we're looking at here is looking at this line chart. And as you're seeing over this particular time frame, REITs have beaten the market. So the market here returned about, let's say 8%, and the REIT returned about 11%. So, it's about a three-point difference there that the REIT has beaten the market. And there are other ones, I didn't want to go through all of them, but if they have ones from like 20 and 30 and 40 years that are roughly the same. The REIT beats it by about anywhere from 3 to 5 points. So over the long term, REITs generally beat the market. And a big reason for that is, so the actual REIT itself, the appreciation of the stock may not beat the market, but this is what they call total returns. And what total returns is, total returns factors in the return of the dividend. So REITs, a lot of times REITs will beat the market because their dividends are so large relative to typical stocks that, if the market returns 10%, and if a REIT just matched the market at 10%, once you add in the dividend of that REIT, say it's 3%, now the REIT has returned 13%, where the market has returned 10%. So typically REITs will outperform the market just because they have those large dividends.
And as you can see from the chart, and for those listening, the chart shows that REITs aren't impervious to the dips in the market. If you look at 2008 with the credit crisis, it still has a dip. And as you can see, the dip didn't just go away. It didn't go to zero. The companies didn't fall off the face of the earth. So there are a lot of people right now screaming, stock market crash is coming. The stock market crash is coming, pull everything out. When you're out of the market, you have no chance of getting returns like this. So if you pull out of the market, where do you go? What is making up the difference? Is the money in the house? Are you putting it in a shoebox? Are you putting it in the bank? As you know, if you watch Investing Education Academy at all, if you listen to any of our podcasts, or if you're part of our Investing Education Academy Facebook group, we always say you're guaranteed to lose money in the bank when you're compared to inflation. Then is the one place you can stick your money. Well, it's not one, it's many places. It's one of the places you're guaranteed to lose money. So when you hear all these individuals talking about the sky's falling, the market is going to fall through the floor, the market will have another dip. We are in an election year. The market tends to be volatile, period, in an election year. Now you add on top of it the type of election environment we're going into, and the market is guaranteed to be extremely volatile. However, if you've also been with us, we have investors inside of Investing Education Academy that will tell you their experience when COVID really got bad. They'll tell you their experiences during some of the peaceful protests. They'll tell you about their experiences just while the market was in disarray, and they still had a positive rate return on their investments. Some had negatives, but if you have a well-structured portfolio, the negatives don't hurt as bad. But for the people out here saying the market, the market's about to crash, the market's going to have a correction. It's going to come. But at the same time, it's not going to wipe out all your profits. And please go to our Facebook group, because recently we put up a post from one of our old clients, like more so a friend that we used to help out, who is down 66% on their account. And you will see what their account is still doing while being down 66%. So these real estate investment trusts are not impervious to market ups and downs. You can see it if you look at December 08. If you're listening, at December 08, you see a drop in the interest paid out, roughly about anywhere from 4 to 6, 7%.
No. This isn't the interest paid. This is just relative. This is just returns relative to the market. So this is
the stock exchange traded equity REITs is what it says, the green line, right?
Yep.
So it went from roughly 12%, right to about 7%, then bounced back up to 12 again.
Yeah. Mm-hmm.
So just showing you all that it did have a dip in the interest that it was paying, but it went back up, similar to how the market performs.
Right. Yep. So, and like Brent said, in times of turmoil, kind of like we're having right now, things like REITs are again, do your research, but they can be good investments because, again, that high dividend. If you're in a stock, the market is crashing. As I said, that high dividend can pad those losses. So if you're just in a pure momentum play that's down 50%, with no dividend, you're gonna get roughly killed. But if you're in something like a REIT that may drop 15, 20%, but at the same time it's still paying you 8% over the year, do the math. By the end of the year, even if the dividend remained down, your loss is going to be cut significantly because you're getting that high dividend. So REITs are definitely defensive. As Brent said, they're not very they don't move that much. Some of them are volatile, but generally they don't move that much. But they do, if you find a good company, they do trend up, and then you do have that large yield built into it. All right, so yes, so okay, so this is slide 3 now. This is an interesting one. So what we're looking at here is a bar chart. At the bottom of the chart on the x-axis, it's showing the year. So it's showing 1 year through 37 years. On the left-hand side, on the y-axis, it's showing the percent. So basically what this is showing, and this is kind of what I was saying before, kind of like over the long term, REITs really outperform the market. So this is showing the percentage return. Well, the percentage that the REITs outperform the market, right? So if you look at the first 1 through 10 years, you can see right there the 50% line. You can see that the line, the green bars only went over it 1, 2, I think 3 times. So in 10 years, the first 10 years of this chart, REITs outperformed the market only 3 times. So they lost against the market 7 times. Now I put a blue box around basically the rest of the chart. Now you see at about 10, 11 years, you see where things really start to take off. So at about 15 years, REITs beat the market 60% of the time. At about 23 years, REITs beat the market 80% of the time. And then when you go out to about 30, 32 years, there's not one time where REITs lost against the market. So what does this mean? Yeah.
When you're saying outperform the market, what does that mean? Can you define that?
Yeah, so outperform the market just means the REIT beat the market. So if the market, and we'll say the market means like the S&P 500, if the market returned 10%, the REIT may have returned 13, 14, 15%. It just beat the market by at least 1%. So outperform means you just beat the general market by at least 1%. And so what this is showing is that over the long term, REITs really, really outperform the market. Like I said, at about 30 years, or at about 30, 33 years, there's not one time going back that far where the market beat a REIT. So this is really, really powerful information showing that. So these are really good for like long-term holds, maybe like a retirement account, because you want to hold these, looking from what this chart is saying, minimum 15 years. So these are really good for like retirement account. Remember, if you're holding for 15 years, you're getting that large dividend as well, 5 to maybe 10%. So you're getting that good appreciation and that really good yield, dividend yield return, over the long term. So again, this shows over the long term, REITs really, really do beat the market on a steady basis.
We got a question that came in, and the question is, what are we looking for when we do research? Number one, I love this question, Beverly, because being a tax attorney, this is right up your alley. The answer to this question is right up your alley. You want to look for their financials. You want to see where is the money coming from that's paying the dividends. Is it from profits? Was it, maybe they did another round of funding? Are they borrowing the money from, are they leveraging funds in order to pay out the dividends? These things, when you look at the financials, you start to realize the viability of the company. So another thing you want to look at is management. How is the company managed? That's very important, because if it has a poor management or a poor board of directors, you will know that the company more than likely will be in turmoil because it's not a strong board. And you can look at the historical performance of the stock as well. If it's a real estate investment trust, I normally want to look at 3 to 5 years of history. I don't want to look at a real estate investment trust that just came out in January and they're promising 13% dividend forever. I don't believe them. I think they're lying. So that's not what I'm looking for. But if I'm looking at a company that's been in existence 10 years or more and their dividends tend to hover around 7%, 4%, I feel pretty good about that company. And they have strong financials. And you can find a lot of this information, everybody. It's not like we have some secret magic box. You can go to Yahoo Finance and find out a ton of information on these. You can join Investment Education Academy, and that is a great place to learn about these things. It's a lot of ways you can get the information. And Leon nor myself ever want you to be beholden to Investment Education Academy for your investing success. You can find it, you can Google it. Just think about it sensibly. You want to make sure it's a strong company that has strong financials, that has a history in the market that has been reasonably positive. don't dismiss a company because they had a bad year. That is part of investing. That's part of business. Look at I say 3, 5, if they have 10 years worth of information, great, but 3 to 5 years at least for me.
Nope. And one point I want to make is a really important point, is that now this blew my mind when I found this out. So REITs by law have to pay out minimum 90% of their profits to shareholders via dividends. So I'm gonna say that again. REITs by law have to pay out minimum 90% of their profits to shareholders via dividends. So think about that. Where else in this world do you get 90% of anything, right? Anything, 90% of anything, much less you are guaranteed as an owner of a REIT, you are guaranteed to get distributions of 90% of that company's profits paid to you every year. That is ridiculously powerful. And I mean, of course, we always want a stock to go up, that stock that we buy. But again, if the stock has a bad year, you're padded big time. If you have that, anywhere from 5 to 10% dividend yield, cushioning your bottom. And also, again, you're getting 90% of that of that company's profits going straight into your pocket. So I just want to make that point again. Just hear me loud and clear. REITs by law have to pay 90% of their minimum 90% of their profits out to shareholders via dividends. That was an insane stat when I researched that. Powerful.
And for you all who are thinking like, this is all great, this sounds, wonderful, but how do I get started? Like, I've never been in a real estate investment trust. I really don't know what they are. And this is not a plug for IEA, but this is the truth. You can, join IEA. We're having these conversations inside of our framework. Actually, the conversations are becoming amazing inside of the IEA platform. So thank you to everybody that's been in there, really laying out the information. But also call the investor relations department. I'll say it again. If you are just getting started and you're thinking this might be too overwhelming, I don't know how to get financials, I don't know how to get this, that, and the third, find out a REIT that you like. You can Google it. You can go to Yahoo Finance. It's a lot of places you can go. Once you find one that you like, call their 1-800 number. It's very simple. And ask for the investor relations department, and or if they say they don't have one, which if it's a real estate investment trust, they probably do. And if they don't, that's a red flag for me. So ask them for a prospectus. Tell them you're a possible future investor. You would love to see the prospectus. Where could you either find it online or can they send one to you? They'll normally send it to you electronically. Back when Leon and I got started, they would actually mail it to you. Right. And so it's really easy to do.
Yeah, I mean, yeah, as Brent said, the investor relations is there for that reason. They're there to take calls from investors. And like Brent said, if they don't have one, that's a red flag. You can't find an investor relations resource on their site. That's a big, especially if you can't find one and they pay like a 21% dividend yield. That just run the other way, because that sounds like crazy fraud. But yeah, definitely look for their investor relations on their website. Hey, Brent, can you go back to slide 1?
Yep. And while I'm going back to slide 1, just funny story. Leon and I shared a while back one of our experiences. It was my experience inside of a real estate investment trust that I had that was buying real estate for senior citizen homes. And you got to think, baby boomers account for 72 million people in our population, right? So I thought this is a no-brainer. Like, this is going to be great. I got cocky in the market. I was like, I know this is going to be good. Everything about it seemed strong. And I slipped. I didn't look at the financials. I didn't look at where the funds were, they were paying their dividends. If I would have looked at their financials, they weren't doing anything fraudulent, but it just wasn't good business. They were taking loans out to pay a 9% dividend every year. And I owned them for a number of years. And when I saw them start to go down, I then looked at the financials and realized what was happening. But at this point, I was just so curious. In the 26 years of investing, I never had any stock ever go to zero. I never had a stock go to zero. And Senior Housing Network was the company. And I was just so curious if it could really happen. I kept them. And I literally watched this stock go to 0.000007 cent. I mean, 0.0007 1/100th of a thousandth of a penny. It was unbelievable. And then they got delisted, of course. But do your homework, and don't think, again, Leon and I are behind this iron curtain where nothing ever happens. It does. I mean, we can share our war stories all day, but and this is why we always say you have to do your research. Don't blindly just go, oh, I saw these four on their screen, that's what I'm going for. We want to educate you to be independent, not to just blindly follow anything we say.
Right, exactly. Yeah, definitely never blindly follow anything we say, anything Warren Buffett says, anything anybody says. Always do your research. So here at the bottom of this chart now, what you see that we found 191 publicly traded REITs, and we're going to make the list available at iamembers.com. But we just pulled out 4 of them from here. These are random. We just picked 4 out of the 191 that we found. So the main thing I want to point out, these are ones you can look up yourselves and research and see if there's something you want to do. But I really want to point out the dividend yields. So you see CubeSmart is paying a 4.5% dividend yield. Now remember again, savings accounts are paying roughly 1.5% if you're lucky.
Yeah, if they're lucky, really lucky, like super lucky.
Yeah, if you're super lucky, right. You're paying 1.5%. And remember, the average stock is paying about 2%. So again, this is a huge percentage more than you're going to get either one of those at 4.5%. Prologis, which they deal in supply chain management, some form or fashion. Again, we don't know anything about these companies. We just pulled them from our list. Just want to show you the different yields that are offered. But Prologis is paying a little over 2%. Remember, I always make the point that for me, I want the yield on any stock that I buy or REIT to be at least 2 to 3%, because to beat inflation is typically 2 to 3%. So I want my dividend yield to be at least minimum 2%. Really more than that, but minimum 2%. So Prologis is paying a 2.2% dividend yield, which is decent. This Global Medical,
Leon,
yeah.
Can you explain why you want the 2% dividend yield? I mean, you said it, but you didn't explain it.
Yeah, because as Brent said earlier, it comes back to inflation. If I'm going to go into an investment, I know inflation generally is 2 to 3% per year. So if somebody's going to like if you're looking for an interest rate on a loan or not a loan, if you're looking for interest rate in a savings account, it doesn't make any. That's why Brent always say it doesn't make any sense to put your money in a savings account that's paying you less than 2% if inflation is 2% or higher. That means you're literally losing money every day that your money is sitting in an account that's paying you 2% or less, because inflation is eating away at it. So if I'm going into a REIT or any stock and I'm looking for a dividend, I want the dividend to at least be 2%, because I want that dividend to help me fight inflation some. So that's why I want my dividend to at least be 2%. I really like 3.5 to 4%, really, but I'll take 2%. I don't go below 2%. If it's below 2%, well, let me not say that. If it's a growth stock, I'll go below 2% because I'm betting on the appreciation of the stock. But generally, if I'm looking at a dividend stock, I want it to at least be 2%, really 3.5%. But again, the reason is I want that dividend to beat inflation when inflation is about 2 to 3% per year. So that's why for 2%.
And for anybody who's listening to this, this would be our charge to you. Call your bank tomorrow, or go online after now while we're talking, or when we're done. Go online and just take a look at what your interest rate is on your savings account, on your money market account, because you don't have an interest rate on your checking account. Most cases.
Right. And if you do, it's like literally 0.00001%.
Yeah,
so.
And if you have an interest rate on your checking account, it's more likely they're requiring you to have a minimum amount in the account. And if they're requiring you to have a minimum, that means that money's not working in somewhere else.
Right.
So you got to think about it. Is it worth it to keep money in this account to get a minimum interest rate of maybe 1%, or to avoid fees? Because really the fees cut into your rate of return, your total rate of return. But that's going to take us down a whole new street. The charge is this to you all, everybody listening, everybody watching. Look up what your interest rate is at your bank, and I would be happy. There's no way really not to put your name to it, but if you would come over to Investing Education Academy, the Facebook group, and just tell us what your interest rate was, or what you found out. I would be very interested in seeing what the numbers are.
Yeah, I would too. Okay, so the third one is Global Medical. That's a medical REIT, and I believe they own things like hospitals, old folk homes, things like that. And you see that I couldn't think of another word. I felt bad saying that, But yeah, I got brain tied there.
I didn't even need to laugh when you said it.
Yeah, nursing homes is a better term. Yeah. But
Senior citizen centers.
Yeah. Right. But you see the yield on that one, 6.67%, which is really, really good. And then you see the one at the bottom. Now, remember I said earlier, mortgage REITs typically pay in that 10% range. So here, this is Blackstone's mortgage REIT, and it's paying 10.41%. That is a huge rate of return on a stock on a REIT. So these are 4 examples of the 191 we found. Have a shot at these. Go research them, look them up, see if you like them, see if you don't. But I would encourage, like Brent was saying, encourage you to definitely look up REITs. REITs are a really, really good way to earn yield, way to earn return on your money, regardless of what the stock does. Of course, we always want the stock to go up, but even if it does go down, the REIT can either bail us out or at least cushion our losses. So, REITs are really good options.
We have some people actually. Brian Olds of Black Speaker Network just posted his. He says he has a bank paying him 3%, and that's another thing. It made me think of a point. If you have a credit union, the way the hierarchy is in the banking system is normally brick and mortar retail space, retail bank, you're looking at the worst rate of return because they're still trying to pay shareholders. They're still, spending money on BOE or business overhead expenses. The normal operating capital budget is being expended on just staying in business. Then you have credit unions. Normally, if you have a credit union, you're more likely to get a higher rate of return. Not only a higher rate of return, but you tend to have less fees. And then you have what Brian's talking about is online banks, online only. When you have online only, you take away a lot of the business overhead expenses of a traditional bank. And now, like banks like HSBC, and there, if you remember, there was a time period where it was, Leon, do you know what that orange ball? Was it ING?
Yeah, I think it was called ING Orange. Yeah,
ING Orange. They got bought out though. I'm not sure who bought them out. Was it PNC?
That was like 10 plus years ago.
Yeah, but they were they were killing it. At one point, their interest rate was 6%.
Yeah. Oh yeah.
For like a savings account, it was 6% for a savings. We're not. So right now, I'm not even talking about the stock or the dividend. The savings account was giving 6%. But anyway, just to tell you all, when you move through these 3 systems, brick and mortar, traditional, publicly traded bank, you're going to tend to have lower interest rates. Then you move to credit unions of any sort, you tend to have lower fees, slightly higher interest rates associated with savings accounts, bonds, money markets, things of that nature. And then you move to online only. Online only, a lot of the expenses that other institutions have to pay for brick and mortar don't exist. And of course, since the expenses don't exist, they tend to have higher profit margins. And those profit margins correlate into higher dividends or higher interest rates, not dividends, higher interest rates on their accounts for you all. So just so you know.
And that's a good point by Brian. But one thing though with those is that because they're online only, there's no brick and mortar. They sometimes can be harder to access. So like I had an experience with one where I hated it for me because because when I got money, I can only go to one location that I could actually physically. Basically, I couldn't. It was hard to make deposits. Is what I'm trying to say.
How long ago was that, Leon?
I tried one. This was like 3 to 5 years ago.
Okay, I like to think that it's different now, but when you start working with cash though, especially if you have a cash business, I totally agree. When you start moving cash and it's online only, it does get cumbersome.
Yeah, well, that's what I'm talking about. Yeah, it was cash. Yeah, if I want to go, like if I had gotten some money from wherever, if I want to go deposit cash, it was because I had to go to this one location, the only place I could deposit that cash. So online only, while they do pay higher rates, I agree. It can be a little more cumbersome if you're trying to actually bank with them. It depends on how you bank. If you're cool with everything being virtual, great. But I know for me, I didn't like it because when I had hard cash, it was hard to make deposits. I would wait weeks and weeks and weeks, and then go make this one trip to go make deposits. So it was a headache.
So everybody knows that carries cash. And Malcolm just said, one of the things thank you, Malcolm, for saying this makes sense. In a global pandemic like COVID-19, a global medical might be a really good play, because the reality is this isn't going away anytime soon. But Malcolm, I'll say this in addition to what you're saying. If you look at the population makeup, we're still talking about baby boomers being 72 million strong. That's a lot of people. And that's a lot of people who are going to need some type of nursing facility, or they're going to need hospitalization at some point. It's a higher probability that they'll need medical attention. Yes, so hospitals, places that invest in senior citizen centers.
There you go. Yeah.
It all matters. It really does. But then you look at the next one is Gen X. We are still the biggest population at 83 million. So, we're hitting that period where, we're starting to have like our medical concerns, and we're starting to look at what does the long run look like for us. And so in the space of medical companies, yes, they make sense. But Malcolm, I still say, and to anybody watching, you still want to get a look at the financials. And the biggest thing about IEA, and this is what I love, is our members' vocabulary is changing. Our members' conversations over dinner is changing. So what we also want is your mentality towards being an investor to change. Call the company and say, I want to see your books before I do anything. You are in the power position. This is what they're designed to do. But for some reason, from a mentality standpoint, I'm stepping off our main point because it's important. We have the mentality that we can't demand to see their books. We can, and we can we can do it before we ever invest $1. So we don't have to be uninformed investors. We absolutely don't have to do that. If today is the day you go, I never thought about it like that, then I'm glad you listened to this. I'm glad you listened to the podcast, because this is real. This is how you change your life. This is how you move through life as an owner, not as a retail buyer. So, cool.
And as Mo said, yeah, so Mo, global medical could be a good play. But as we said again, do your research. I cherry picked these because I wanted to show the variation in the different yields and how high they can be. But I have not looked deep into any of these. So, these are something that everyone can research. Again, do your research. But your point is well taken, Mo, that yes, anything to do with medical in this country going forward is potentially going to be huge, because as Brent said, baby boomers, then us, our generation, we're getting older. We're going to start needing, a lot of medical care in the coming years. So, so it's one of the areas that kind of like tech, where it's almost going to be, nothing is guaranteed, but it's going to be one of the areas like tech where you probably see some really good returns, especially with Reits as well, because again, those high yields that Reits pay. And so our last point is Beverly's favorite portion, where we give our weekly, and Mo too. Mo, I gotta give you a shout out because you wait on them picks too. We're gonna give you our stop picks of the week. So you want to go, Brent, or me?
Yeah, I can jump in there. I'll go. Let me do a screen share. Mine is again going to boil down to the reality where we are in our world right now. My pick is PayPal. And, actually, I had to go back into our picks. I couldn't believe neither one of us picked this yet.
Well, I must say, you picked Square, and I heard PayPal earnings today. I was thinking, yo, Brent's pick is going to be ball. And I was like, wait, no, he picked Square. So, yeah, I'm surprised neither one of us picked PayPal either.
So, PayPal is, and for anybody that doesn't know what PayPal does, I'll read it to you. PayPal Holdings is an American company operating worldwide online payment systems that support online money transfers and serves as an electronic alternative to traditional paper methods like checks and money orders. So maybe this would have stopped you from having to carry around cash, Leon.
Possibly. I mean, if I'm paying cash, what am I supposed to do?
That's the options trade life for all you options traders. So PayPal Holdings, and I have a fact. Now, if you're watching this, you want to stick around because I have a fact about PayPal that I think is going to flip some of you all out that you probably didn't know. PayPal Holdings is trading at roughly $184.60. Now, we don't have to look at the aftermarket trading or anything like that. The biggest thing about PayPal that I like is some of their subsidiaries, companies like Zoom Corporation Honey. And if you all aren't familiar with Honey, the way Honey works is it helps people find better prices for whatever they're going to buy. So if you have a Honey account, it serves as like I don't know what you call it, but it's like a Chrome. What's that called?
It's like a Chrome plugin.
Plugin, yes. And so when you go to buy something, Honey kicks in and goes, wait, let's see if we can go buy anywhere else. And they get a percentage of the difference. So it's kind of like a stock where they get the spread is the difference between the buy and the sell. They get that difference between the original price and the sell price. They get a piece of that. And so that's how the company wins. But, in that space, PayPal is one of the best known brands for transferring money electronically. Mm-hmm. As we get into a world where cyber security issues plague us, and we want to transfer money with somebody who we're comfortable with. We want to transfer money with somebody that has, a staying power. Like they're not going to disappear. So that's what I love about PayPal Holdings. When March the 19th hit, just like everyone else, they took a huge dip. Well, it wasn't even really huge, but they took a dip. But once we realized that COVID was forcing us to stay in the house, everybody started buying things online. Mm-hmm. Like everybody, people that never thought they would have a PayPal account, set up PayPal accounts. Businesses now, you set up like your business account, PayPal account, Stripe account, and then everything else is, tertiary to those primary ones. So I love PayPal. I think it's gonna be around for a while. Now, this is the piece that I think will make most of you all go, what? Did you all know that Elon Musk is one of the founders of PayPal?
Yep, I knew that.
Yeah, I mean, I know you knew that. So I'm pretty sure people watching are like, what? Nah. Yes, Elon Musk is one of the 6 founders. So I thought that was crazy interesting. For me personally, when I did the research on him, I hope you all enjoyed it too. So my pick is PayPal for my July 29th, 2020 pick.
All right, and my pick. So I stuck with I went with the Reit. I stuck with kind of our theme. So I picked a company called CareTrust Reit. You didn't get the ticker symbol for PayPal, did you?
Oh, okay. For anybody, the ticker symbol for PayPal is PYPL. Again, the ticker symbol for PayPal is PYPL.
Yep. Okay, so I chose CareTrust Reit. The ticker symbol is CTRE. That's CTRE is the ticker symbol. Today it closed at $18.13. It was up 3.5%. So Mo, this kind of goes to what you were saying. They're a REIT, and they're involved in acquiring and leasing senior housing and healthcare properties. So they're playing in the whole healthcare space, which, as we said, going forward is going to be a huge space based on our generation and then the baby boomers. And they actually have really good numbers too. So their 2-year average profit growth is 6.5%, and their average sales growth is 9.7%, so almost 10% growth there. Great part about it is they pay a 5.55% dividend yield. So really strong dividend yield. So on a $10,000 investment, you're going to make $550, regardless of what the stock does, up, down, or indifferent. You're going to make that 5.5% on your money. So my choice is CareTrust Reit. Ticker symbol is CTRE.
Mo said the earnings calls are coming out. We're out today.
Whose?
Let me see.
I think he made talking about PayPal.
I'm not sure if it was on PayPal or in general. And Brian just said he knew about Elon Musk, and that's how he made part of his money. Elon Musk has a hand in a lot of things. When you start peeling back the layers, like I had no idea. But
yeah, he's deep in a lot of stuff. Yeah.
Yeah. So these are our picks today. Is PayPal, symbol PYPL, and CareTrust Reit. And again, the Reit stands for Real Estate Investment Trust, and the ticker symbol is CTRE. Someone actually sent me a direct message and was like, "Why do you all keep saying ticker symbol?" So a ticker symbol is a symbol by which a stock trades on an exchange. So if you go to an exchange, if you were to look up a company to trade, you couldn't just type in PayPal. Right. Technically, with technology being what it is, it will correct you. and it will tell you probably what you're looking for. But you want to know the ticker symbol, the symbol by which it's trading, because there are these different share classes, number one, out there. So you have to make sure you're buying the share class that you originally intended to. And then to add a whole new layer of confusion in, which I'm sorry, but the question was asked, you might be buying an ADR and you don't even realize you're buying an American Depository Receipt, which is a version of some companies, one of the offerings they have out there, but maybe isn't intended to be the US offering for that share, that company. And we had somebody in Investing Education Academy go out thinking they were buying the US based share class, and they ended up buying an ADR of the company. So now it's important that people know, if you hear anybody say ticker symbol, it's the symbol by which the company trades on an exchange. Always know what it is and make sure you have the right one, because sometimes there are symbols that are very similar but different.
Yeah, one that caused a lot of confusion with a lot of investors is actually what we're on right now, Zoom. So Zoom video, the thing that everyone knows, everyone's using now for home video, their ticker symbol is ZM, right? But there's another company called, I think it's called Zoom Technologies, and their ticker symbol is ZOOM. A lot of people that wanted to buy Zoom video, the one we all know, ZM, went and bought Zoom Technology, which was ZOOM, and bid the stock huge. I mean, the stock ran up, I don't know, it was like 10, 20%, because everyone got the ticker symbol wrong. They put in ZOOM versus ZM. So that's why it's very, very, very important that you know the ticker symbol, and it's also called a stock symbol. Ticker symbol, stock symbol, which, they're interchangeable. But typically ticker symbol is used. But it's very important to know the ticker symbol because, again, you want to make sure you're buying the correct stock.
Yep. And just to end this, we wanted to say stock market investing is definitely a volatile place. It's not for everybody. Make sure you're using a certain kind of money when you invest in the market. And Leon, that is called?
That is risk capital. That's money that you can lose and you won't even miss it. Money that you're not buying food with, you're not paying your medical bills with, you're not sending your kids to college. It's money that you can literally lose and you wake up tomorrow and life will go on.
This Saturday, inside the Investing Education Academy platform, we have the Ask an Expert series, and this will be our second one. It will be at 6 p.m. on Saturday. It's members only. It's for all member classes. You can come in and ask your questions to our experts. We do this once a month where you have the opportunity to ask an expert, and we also will be presenting next week our first private equity deal, so to our portfolio Panthers. So this is going to be pretty exciting to actually do it. Bakari Haynes took the hot seat as our first ever hot seat survivor, and we want to thank Bakari Haynes publicly. We have a hot seat where our members, they take the hot seat. So on our conference call or our Zoom meeting, they answer questions about why they invest the way they invest, and they actually show us their portfolio. That's the part just like, woo. And next month, we have attorney Beverly Winstead, who will be taking the hot seat. And this is going to be pretty cool because she was named one of the top attorneys under 40 in 2018. So we get to see how a tax attorney invests in the stock market. So This is going to be a really cool hot seat coming up in August, and it's members only. And for that one, it's insider level or portfolio Panthers only. But that is going to be one I'm really looking forward to seeing how a tax attorney manages their stock portfolio. So for anybody interested, come over to Investing Education Academy Facebook group, or you can go to www.ieamembers.com and get your membership today. Our lowest membership is $36 for the year. And I don't know too many places where you can get a membership like that. But Leon and I, when we did the piece on the wealth gap in the US and realized that it was so wide. I mean, it's looking like the way it is, it seems like it'll take 230 years for us to catch up to white counterparts. And that's just ridiculous. So when we did the research and we found that out, we went back and changed our pricing. We changed all of our pricing. So that our lowest package was going to be between $2 and $350. for the year, and our next tier up was going to be between like 4 and 1,000. We weren't sure, and then our highest one was going to probably be about $7,000. So we went in and we made our lowest tier package $36 for the year. And our thing was, we want to make sure whoever wants to learn about investing can. I mean, if you have the ability to invest, you should be able to, pay $36 for the year. It is for the year. It's still amazing me. But we feel like it's our duty to educate as many people as possible. And the platform is very rich. It's not like, you get a lot. And so for anybody who's interested in joining, we welcome you, because this weekend we will be doing several members only events. And so we hope to have you participate. But more than anything else, our members have started buying memberships as gifts to grandkids and gifts to godchildren. And that is awesome, because most recently, I think this is amazing. And I hope we can start having a mentality like this. I am so proud of just the conversation. One of our members' goddaughter just turned 21. She told her that she would either buy her an IEA membership, which was the community membership, $36 for the year, or she would buy her an insider. Let me change that. She would buy her IEA community membership, which is $36 for the year, and she would give her $440, which is the difference between the next part of this, or she would take the whole $500 that she was going to give her and buy her an IEA insiders membership. But it was her goddaughter's choice. And this young woman chose to take the IEA insiders membership instead of getting $400+ to do whatever she wanted with. And so we're figuring out what we're going to do for this young lady, because I feel like we have to do something extraordinary, because we have to reward that mindset. And it's cool that this thought process, and that even financial education is a gift now being given. Mm-hmm. And that we can be a part of that is actually really just a blessing to us. And we want to say thank you, which is why we're pontificating at this point. And the main part is over, but it just had to be said that, one of the reasons why Leon and I started this was to change the mindset and the information available to people of color about the market. And it's happening, and I'm thankful for it.
Now, I just want to say on that point is that, and we'll end this after this, is that, again, Brent said the reason why I did this is when we did the research. Well, just to kind of rehash the research, we found out that African-American wealth today has just now caught up to white counterparts in America, where white wealth was back in 1962. So we're 60 years, African-Americans are 60 years behind. The wealth gap is essentially 60 years. We're 60 years behind white wealth in this country. On top of that, the second part we did we did a whole 2-part live on this, but the second part of the live showed that something that we're dubbing the ROI gap showed that African Americans on average earn 139% less on their money than white America does. Those two stats are just mind-boggling. And that, like Brent said, that's why we took our lowest plan and just dropped it $36 for the year, because we were like, we have no business charging anybody almost anything once we saw those numbers. And so that's why we brought that in at 36. And that's why we're, as Brent said, we're having people gift stuff, gift memberships to this. We're also, I don't know, Brent, we'll talk about it now or later, but we're gonna have scholarships coming up for IEA. So we're just trying to open this thing up as wide as we can, because again, that wealth gap and ROI gap is just absolutely insane. That in the year 2020, with all the technology, that African Americans are still so far behind with wealth and with return on their money. It makes no sense.
Yeah. And as you guys get into the market, it's going to be volatile. It's going to be a rough ride sometimes. The market isn't always positive, but this is one of the best ways for us to leverage or change the ROI gap. Like this is it. Real estate, business owners, entrepreneurship, and investing. I mean, those are the big three. And for generational wealth transfer, is life insurance. Mm-hmm. So when you talk about, filling that gap right now, those are the three while you're living, and moving into the transitional life, if you will. Life insurance is the biggest play. So I see people asking for the link, and considering we have 35 comments in the comment section right now, we know we have some homework to do when we get off of the live. we will start replying to you all. But from the bottom of our hearts, really thank you for believing in us. It's going to be a bumpy ride in the beginning. This is new to us too. But as we get better, we're transparent about who we are. We're not the hustlers, but we also say the market is the market. And if you're in it for the long haul, you're more likely to win.
Right. Yep. And I would say the market is a great equalizer. And Brent and I were having a conversation. I kind of made this analogy, like the market is kind of like, it's sad to say, market's like the virus, right? The market doesn't care if you're black, white, rich, poor. As long as you have like the virus, as long as it can infect you, it doesn't care. Same with the market. The market doesn't care. As long as you have money to invest, the market doesn't care. So the market's a great equalizer. You can be somebody with $1 billion and somebody with $1. You can still buy Microsoft. You can still buy Facebook. You can still get 20% return a year, 100% return a year, whatever. So yeah, the market is a great equalizer.
Yeah. So with that being said, we thank you all, and we will see you next Wednesday at 9 p.m. For everybody who is already an IEA member, we will see you Saturday at 6 p.m. for our Ask an Expert series. So look forward to just the engagement, and you can always, regardless, you can always go to our Facebook group, Invest in Education Academy. Just Google it, not Google it, just search it on Facebook, and we'll see you there. Have a great day.